All right, let's go ahead and get started. I appreciate everyone joining us today. My name is Kyle Veenstra. I'm in the trading area here at Global Atlantic, and this is part two of our discussion on the split dollar concept. Now, I see some familiar names out there on our attendees, so I'm glad that those of you that were able to join us this morning came for round two. Those of you that were unable to join us, no problem. The content still is very relevant. We do have access to that recording. I've already had some requests in the chat. So we'll make sure that we get out today's recording as well, earlier session recording as well as the session that we're about ready to do today. Just want to cover a few housekeeping notes before we introduce our speakers. Due to the amount of people and a large amount of people that we have on the call today, we have muted the phones on your end, just to keep that background noise down and to make sure that the recordings are really good quality. If you have any questions, use the Q&A feature there. That allows us to be able to get those questions, if we have time, to our subject matter experts. Also, in the event that we run out of time, if you use that Q&A feature to ask the questions, we're able to take those questions that we were unable to get to and email you the answer to those directly after the presentation, so it helps us. Also, we will get the content out to you in terms of the recording and any applicable pieces that are talked about today. So no need to jot down everything that's on the screens that you see. We'll give you access to that as well. So we really want you to dive in and listen to our experts as they review this. So without further ado, let me talk to you about the people that will be providing the content today. First, we have Dave Graham. Dave Graham's the VP of our COLI distribution. A really good resource that we have here at Global Atlantic, particularly on advanced planning, advanced sales concept. Has decades of experience, as he let me know, and really is a great guy and a great resource. You'll find that he knows what he's talking about, plus very reachable, very approachable for follow-up. So definitely take advantage of Dave as a resource here at Global Atlantic. We also have Randy Zipsey with us today. Randy's a VP in our advanced markets, advanced sales area. Again, a wealth of knowledge, particularly on conceptual selling, written books. He's done podcasts, just another great resource we have here at Global Atlantic. And just like Dave, from an approachability and accessibility standpoint, very similar. These two guys are great resources, and as you'll see, tons of knowledge in this space, and they're willing to help. So definitely, as the presentation ends and you kind of look to implement some of this into your own practices, don't hesitate to reach out to Dave, Randy, and the rest of the advanced markets team. So I'm going to stop there. I'm going to pass it over to Randy.
Well, and thank you very much for that. You know what, I listened in on the 101 discussion earlier in the day, and I thought it was great, and it was a very good starting point. So we'll try to get over some of these first slides real quickly, but because some of you didn't listen in, we will touch a little bit on some of the basics. But here's what I think. If you want to talk about split dollar, ask an old guy. And I'll tell you what, I certainly qualify as an old guy. I've been doing this for 30 years. When I first started as an advanced salesperson, the answer to every advanced sales call was split dollar. It was split dollar because it was ability to leverage the gift tax exemptions, which were low at that point in time. It was split dollar in a business context because it was the best employee benefit, the best way to move cash values on a tax efficient way from a business to an employee or a shareholder. Guess what? Sometimes things come back into vogue. And you know what? Split dollar is back because of the low interest rates. We're going to talk a little bit about why that is and how it works. But to me, split dollar is, it's the 57 Chevrolet or the 64.5 Mustang of estate planning. It never went away, but it is cooler today than it ever was. And Dave and I are going to tell you a little bit about that. What is a split dollar loan? I mean, a split dollar loan is simply what it seems like, right? It's an arrangement to fund a life insurance policy. It's not a life insurance policy. It's a funding mechanism for a life insurance policy. Typically, an employer will advance the premiums to an employee or to a shareholder, and that advance, that loan will eventually be repaid, maybe during life, maybe not until death, but that it's just a loan from the business to the employee or to the shareholder. The interest has to be at a certain interest rate called the applicable federal rate. As you see from the slide here, the applicable federal rate, AFR, is lower than it's ever been in the 30 plus years I've been doing estate planning. The short-term rate is 25 basis points, meaning that you can have a loan of up to 2 years, 364 days at 25 basis points. Or you can have a midterm loan, which is be three years and less than 9 years at 58 bips. Or you can have a loan of 9 years or longer, up to say 30 years for 1.15. Me, and the examples we're going to show here, I tend to start with the low rate. I look at it, I watch it as we move on, and I can always lock in a higher rate if interest rates start to escalate. But the examples I'm going to show you now are going to start out at the short-term rate or 25 basis points. Thank you. Next slide. Okay, Kyle, Dave, who's controlling the slides? Because I'm still on slide 3 here.
Dave is controlling, but his internet is a little slow.
Okay, well then we're on, again, another problem I guess that old people like me are familiar with is being slow. All right, here we go. Whoa, now we got nothing.
All right, let me let Dave figure out what...
I'm adjusting it. I'm going to show my screen to keep it moving there. Can you see it now, Randy?
Yep, I can. Slide 4, repayment. Just as I said, the executive repays the premiums plus interest, as I said earlier, either during life, typically maybe at retirement age, or upon death from the proceeds. But there's a repayment, but it's at the premiums paid plus the interest, and as I already said, the interest is practically zero. Literally right now, it starts at 25 basis points. The ownership, the policies are usually employee-owned. Sometimes if it's for estate planning or an executive that has an estate tax problem, it's trust-owned. But again, the policy that we're going to be talking about in the split dollar loan scenarios are going to be owned by the employee or an employee's trust. All right? Why split dollar loans? Well, it provides a death benefit with business dollars. If you would have listened to 101 earlier in the day, Bill talked about the 2017 Tax Act. Corporations are now paying taxes at 21%. Individuals are paying taxes more at 37%. And if you live in a state with state income taxes, you might be paying close to 50%. So businesses are looking, business owners are looking at ways to use C Corp dollars to pay for insurance. This is one way for that. Or it's an employee benefit as a way to keep an executive in the business. It's a supplemental employee benefit. If Global Atlantic wants to provide me with a loan at 25 basis points that I don't have to repay until I die or retire, bring it on. You know, if my boss is listening here, I'll take as much of that money as you want to give me. That's what split dollar is about. It's about an employee benefit. And it's also, as we're going to show, it's a way for clients with gift tax, with estate tax issues, as a way to minimize those estate and gift tax issues. And if we have time, we'll talk about it in a tax-exempt world. It's an employee benefit rather than deferred comp for charities and tax exempts. Slide 6. This is a diagram from a software tool that's called Design Hub. This is a proprietary tool that we have here that we can show a lot of these concepts and a lot of other ones. This is just out of that tool. It shows how split dollar loans work. If you follow the arrows, what you'll see is the corporation's advancing premiums to the employee is paying interest at the low interest rates, and the executive is going to own that part of the life insurance that is in excess of the premiums paid, which is being retained by the corporation. All right, slide 7. This is example 1, and I'm going to let Dave Graham go through the math on this in a little bit. I'll just set this up. This is a very typical split dollar arrangement, a typical one that we see all the time. This is a estate liquidity situation. This is somebody who is looking at buying life insurance to pay an estate tax bill, or maybe they're trying to equalize estate some amongst the kids. Maybe it's a family business owner, and there's two kids. One's in the business, one isn't. So they want to give the business to the child, and they want to fill in with life insurance to provide for the other kid. But it's an estate liquidity situation. We're trying to eliminate or reduce the gifting to the trust, and we're trying to maximize the death benefit at death. So as you can see, this is a C Corp owner. There's no annual exclusions. The C Corp owner has retained cash inside the business. This policy is going to be trust owned. I'll let you take over here on slide 8, Dave.
Okay, great. Thanks, Randy. All right. So as Randy indicated, we in Advanced Markets get a fact finder in, and we are being asked to design the case. What is the best way that we can put death benefit in this irrevocable trust, because our male age 50 is doing some current estate planning? As Randy mentioned, it's complicated because typically if you have life insurance owned when inside an irrevocable trust, you use your annual exclusion, that $15,000 that you can give to anybody to help fund the life insurance premium inside the trust. This is complicated because there is none. They're using it elsewhere. We're assuming that our male is premier, non-tobacco, and since this is a death benefit sale, we have selected the proper product, being the Foundation Elite product. It is a death benefit sale product primarily. What we have determined is that we will start with a $1.3 million level death benefit, and you'll see how that works here in a moment. We could do an increasing death benefit, but the facts of the case, the objectives of the case will dictate how we set this up. We're going to look at an initial premium of $34,439, and once again, our male age 50 has an assumed tax rate of 32%. All right, Kyle. Here is a portion of the Design Hub output that will be used to illustrate the concept of split dollar to our prospect. Go ahead, Kyle. As you can see, we have $34,439 set up as a 5-pay to fund the policy, that $1.3 million. That will accumulate interest, it'll accrue interest, and you can see that running down the right side, so our loan is not only going to be the premium that is outlaid each year, but also the accrual of interest. Now, the interest is an integral part of split dollar. You either need to pay the interest, it needs to be imputed, or it can be accrued, which is what we have selected here. The interest is required to be accounted for every year in order for this to be a legitimate loan from the IRS's perspective. All right, Kyle? Now, as Randy was mentioning, right now we have an extraordinary opportunity to lock in a very low short-term rate of 0.25%. We can lock that in basically for the first 3 years, and what we've assumed here is that we will monitor the interest rates. They come out every month as part of our ongoing due diligence with this plan. And at the appropriate time, once interest rates look like they're going to start ticking up, we will evaluate whether this would be the appropriate time to lock in a more long-term rate. And as Randy indicated, we can do basically any amount of time, but 30 years is really the outside that we would look to lock in a loan for this split dollar arrangement. All right, Kyle, go ahead. The next slide will show a larger output from Design Hub, and it will give more features, show additional features that are available in split dollar. The left side of the screen you have already seen. That is the corporation's side of the split dollar concept. The right side of the screen is John Taylor's, the owner's half portion of the split dollar arrangement. So what you can see here is that we only have accrued loan interest, but you can also see that we could have paid tax on imputed interest. And then the next column over would be policy or net cost to executive, if we're going to pay interest every year. And then lastly, you can see that this is set up that we can take policy distributions, and you will see that more in the second example with split dollar. All right, Kyle, go ahead. So what did we accomplish for our 50-year-old? We funded his irrevocable trust to provide that estate liquidity or equalization objective. We used the corporation's funds because the corporation is going to only have to pay 21% on the funds, as opposed to John, who was going to have to pay 32% federal. And of course, if there was, as Randy mentioned, if there's any state tax on top of that, it can get rather expensive. We want to use cheap money to fund the trust if we can. We have managed John's income and gift tax concerns on this planning. We completely eliminated his requirement to use annual exclusions in funding his irrevocable trust to pay the premium on that irrevocable trust-owned policy. We did that by accruing interest, and this was a split dollar for life. It will not be repaid until John's death, but it still is able to provide a significant death benefit. At his life expectancy, there was about $1 million on his side, the trust side of the ledger. And
I'd just like to.
Go ahead, Randy.
I'm sorry, Dave. I was just going to interject there. You know, the example we showed you was $1 million policy. This type of example, this death benefit funding, these tend to be very large cases. These are people that can't pay the premium without gift tax consequences. So we're looking at, you know, these are usually $10 million, $50 million, $100 million type death benefit situations that we're seeing today, with the exemptions being where they are. That's the kind of magnitude of case that I'm typically seeing split dollar used for. This kind, this death benefit focused split dollar, these tend to be very large. What we just showed, $1 million death benefit, but of course, you know, if it's 10 million, you just put, you know, it's just 10 times everything on that slide.
Sure. Add another zero to our death benefit, and this looks a lot more important and impressive. All right, Kyle.
The split dollar example 2. This is the one that I think Dave and I are seeing much more of. I'm bumping into these all the time. We're illustrating this concept a lot. And this is, again, split dollar as a employee benefit. And when I'm saying employee, this could be the owner of the C corporation. It could be a key person in the corporation, but this is an employee benefit, and it's especially true with C corporations, although I will say I also see this with S corps and pass-throughs for the non-owners. It's an employee benefit that, you know, from an executive standpoint, if you're a non-owner, it's a great benefit to get as well. And what's going to happen here is the corporation is essentially letting the executive use the corporation's dollars on a tax-free basis and with a low interest rate return for, you know, rest of retirement or whatever time period you're looking at. But again, if I have a high cash value life insurance contract, I'm looking at an IUL type, an accumulation IUL. And that accumulation IUL, say it averages a return of 5 or 6% over the next 20 years, because I'm 50 years old and I'm going to retire 20 years from now. If that policy generates 5 or 6% for 20 years, and I'm only required to pay my employer back the premiums plus a low interest rate at, say, 1 or 1.5%. As you can see, theoretically, I could create a significant pocket of supplemental income that I can access when I get to be retirement age. And that's really where we're seeing split dollar being used most of the time here. And Dave will walk you through this. This is a 50-year-old executive. We assume 20 years until retirement age. And we showed the corporate rate at the 21, which is the actual corp rate. And we showed the executive's tax rate at 32. It could even be higher, but we showed this at 32. Dave, if you want to take on from slide 13.
Right, go ahead, Kyle. All right, so once again, we get the fact finder in. We've got an employer wanting to provide an executive benefit for an employee age 50, and the executive benefit is not death benefit, but it's supplemental retirement income. Therefore, we have selected a different product, not a death benefit driven product, but our cash accumulation product of Global Accumulator. It performs very well in this regard, as you will see. We're assuming the same 1.3 million of death benefit, but this time it's increasing death benefit. We're trying to stuff as much cash into this policy as is possible, with the goal being superior accumulation such that at some point we can use the cash values to repay our employer and still have enough cash value left over to supply a significant supplemental retirement income for our key executive. We're looking at an initial premium this time of $100,000, and our executive has the same 32% assumed federal tax rate. All right, Kyle. So this time our output looks a little bit different. Go ahead, Kyle. Instead of almost $35,000 in premium, we are heavily funding, max funding, minimum non-death benefit of $100,000. Go ahead, Kyle. And you can see that once again, we are accruing the interest on the debt owed back to our employer. This satisfies the IRS's requirement that this be treated as a legitimate loan. Go ahead, Kyle. And once again, we have this historic opportunity to use a short-term AFR under 3-year loan at 0.25% interest cost. Once again, we will monitor this, and at the right time, we will look to lock in a longer term, either the midterm or the long-term AFR when appropriate. A little more on this slide. You can see that we talked about, Randy mentioned that he's going to work for 20 more years. Well, what we did here is we found the first best time to take a policy loan to repay our split dollar loan back to our employer. So you can see at age 68, we took a policy loan from Accumulator sufficient to repay our employer, which then terminated the split dollar, released the collateral assignment. Now the employee has an unfettered, personally owned policy that he can use for any purpose he wants. Well, he's got still 2 more years to work according to our assumptions. So go ahead, Kyle. He's going to repay our employer at age 68. So it's a cost neutral benefit or benefit that's being provided by the employer. Everything's been loaned and repaid with interest. It's really a no cost, if you want to look at it that way, from the employer's point of view. From the employee's point of view, you can see underneath on his side of the screen here on the non-taxable policy distributions, at age, this is 71, well, that's end of year age 71. So at age 70, he's going to start taking from this life insurance policy that he alone owns $75,000 for the next 15 years. And
hey, Dave, just hold it there 1 second, just so our listeners can take a look at that. If you look at the total loan interest that was included in the income tax of this executive, it was $115,000. And if you think about that, say, at a 40% tax bracket, that's $50,000 of income tax, more or less. And that executive, 20 years out at age 70, has access to policy cash value of almost $550,000. So for a very low cost, on this illustration, the executive has a pretty substantial bucket of supplemental income there, which now Dave is showing you, rather than accessing it in a lump sum, maybe the best way to access that is over a period of years. But you could have just cashed this policy out and took $550,000, or as Dave is showing you here, you can take $75,000 out for 15 years. But the total cost of that was just the taxation on that loan interest that they had to pay.
Right.
Thanks,
a
Dave.
Very impressive benefit for sure. Okay, Kyle, next slide. So what did we accomplish? Well, we fully funded a non-qualified benefit for our key executive of this C Corp owner. We used the corporate tax money at 21% instead of using the 32% plus state income tax of the executive's money. So it's a great deal from the executive's point of view. There was no cost for the key executive because instead of paying the interest, we were accruing it, and then we used the life insurance policy to repay it. We were able to terminate the split dollar loan in year 18, even though he was going to work 2 more years. And the policy is the executive's personal asset that can be used for supplemental retirement income. If he doesn't need that supplemental retirement income, of course, he could transfer that policy to an irrevocable trust and wait the appropriate time, and then it's out of his estate if that is of a concern. Go ahead, Kyle.
The next idea that I just wanted to talk a little bit about, and we don't have a lot of the math here because we could spend a lot of time on this, but since this is an advanced course on split dollar, Dave and I wanted to talk about a couple of less common ways split dollar is being used. And one of the things that we're seeing done a lot now is in the buy-sell world, something called cross-endorsement buy-sell. I like to refer to it as retirement buy-sell is the terminology that I like to use for this. But let's just say that Dave and I are shareholders. We each own half of a business. Dave owns half, I own half. When you go to look and you oftentimes talk to Dave and I about a buy-sell arrangement, what's going to happen? It's going to end up being a term sale. I'm going to buy a policy on Dave's life to buy Dave out. Dave's going to own a policy on my life to buy me out, and that's how the buy-sell is being funded. And as the agent, you just sold 2 moderate-sized term policies, whoopee. But what I would suggest is the cross-endorsement buy-sell is a way to turn that term sale into potentially a very lucrative permanent sale, and also a much more beneficial planning opportunity for the client, for Dave and I. Now, instead, what cross-endorsement buy-sell says is, Randy can buy a policy on Randy's life. I'm shareholder A. I'm going to buy a policy on my life. I need supplemental income. Those of you who know me know that I have a 7-year-old at home yet and a child with special needs. They're going to be with me probably for the rest of my life. And I need to have supplemental income to take care of them. On the other hand, Dave is independently wealthy, and he has an estate tax problem. Ain't that right, Dave? And so you're trying to maximize your death benefit to pay your estate tax. He just does this for fun. So Dave and I have 2 different needs. So I'm going to own my permanent policy, but it's going to be a heavy cash value policy. Dave's going to own his permanent policy, which is going to be a death benefit policy. Probably we both want to have a chronic illness or a critical illness right around that, because I don't know why you'd buy a policy that doesn't have that on there. So I'm going to buy that permanent that contract. Now I'm going to fund our buy-sell. I'm just going to rent Dave part of the death benefit of my permanent policy. Dave's just going to rent part of the permanent death benefit on his policy to me for as long as that business exists. Fact of the matter is, most businesses aren't going to end when the owners die. They're going to end when the owners retire, when the owners sell it. Now, when we retire or we sell that business, we just stop that rental and we tear it up, and I walk away with my policy. Dave walks away with his policy. That's cross endorsement buy-sell. Every year, Dave is just going to pay a fraction of the cost for the term element of my policy, and I'm going to pay a fraction of the cost of Dave's policy every year, just equal to that term cost. So on my policy, I'll pay everything but the term cost, which Dave will pay. On Dave's policy, he will pay everything but the term cost, which I will pay. Now we'll each own our policies, and we'll have each other's death benefit to facilitate the buy-sell. So if I die, now Dave gets the death benefit, and he buys my interest in the business out from my estate. That's cross-endorsement buy-sell. It solves a lot of typical buy-sell problems, like, if I own a policy on Dave's life, and Dave owns a policy on my life, the typical cross-purchase buy-sell. I own a policy on Dave's life. Well, you know what? What's going to happen if that business ends? Dave may not even give the policy back to me. What a mess that'll be. So, it's important that you have these things structured right, and cross-endorsement is a great tool. Why don't we flip to the next slide, Kyle? As you can see, that's the rental that I referred to. Okay. And what you can do also, though, is not just with cross-endorsement buy-sell. I explained how the cross-endorsement buy-sell worked, but you can use that loan regime split dollar that Dave and I were talking about earlier. Dave and I own a C corporation, so rather than having the C corporation pay Dave and I compensation to fund the buy-sell, why do we want to have that corporation pay us as shareholders, where we have to take that income at our 37% individual rates? Why don't we just leave the money in the business where it's being taxed at 21 and have the business loan us the money through a loan regime split dollar? So what I'm advocating here on slide 18 is funding that cross endorsement buy-sell structure with the loan regime structure that Dave and I covered earlier. Yes, it's a little convoluted, but that's why you dialed in split dollar advanced, not the earlier one. This is just piling one type of split dollar on top of a second split dollar. It is a heck of a way to fund a buy-sell arrangement. And both Dave and I would be more than happy to walk through this with you sometime if you have an actual case. But it's just using corporate dollars to fund a cross-endorsement buy-sell. You're maximizing income tax, and you're also getting the shareholder the policy that he or she needs for life, and you're fulfilling your cross-purchase buy-sell to maximize the basis when one shareholder dies. You flip to slide 19. And this is from our tool that we can illustrate this with. Go to 20. Okay. This is the cross-purchase buy-sell. Probably we should have put these the other way around, Dave. I've kind of already alluded to what cross-purchase buy-sell was. Rather than the cross-endorsement where I own a policy on myself and Dave owns a policy on his self, in a cross-purchase buy-sell, I'm just owning the policy on Dave's life, and Dave is owning the policy on my life. So in this example, you don't have two layers of split dollar. You don't have that endorsement split dollar between Dave and I. You're just simply funding the traditional cross-purchase agreement through a loan regime split dollar structure. So this is a little bit of an easier structure. I'm not sure it's a better one, but it is an easier one than the one I just talked about. Here I'm owning a policy on Dave. Dave owns Dave is owning a policy on me, and we're going to fund those policies through a premium loan with the business. So it's a loan regime split dollar funding a typical traditional cross-purchase buy-sell. All right, slide 21. Okay, we're on to advanced markets. This is who we are and what we do, but we still have a little bit of time left, so I'm going to take it. What I'm going to talk about here, and I'm going to turn it over to you, Dave, because I know you see this done as well. The way tax exempts work, the way charities work is that you can't do traditional non-qualified deferred comp with them. An executive can agree to defer his or her compensation, sure, and it stays in the business, but in a for-profit environment, you can stretch that deferred money out for a period of time after the executive leaves through the use of things like consulting agreements and agreements not to compete. So if I defer some of my income in a C corporation, that C corporation can agree to pay that back to me at retirement over a period of years, as long as I keep risks of forfeiture in place through an agreement not to compete or to consult. But not-for-profits don't have that luxury. At retirement age, 100% of that deferred money has to vest in the executive. So for years and years, loan regime, equity split dollar, if you will, equity split dollar was used as an employee benefit and tax exempts. Dave, and I know you've done a bunch of that, so I'm going to put you on the hook even though we haven't practiced this. If you want to talk to us a little bit about that.
Okay, sure. As Randy indicated, a continued service is required at retirement for a nonprofit to continue the deferral. Once the retirement happens, it's all taxable. The entire balance is taxable to our retiring executive from the nonprofit. So what we do instead is just like example 2, where we will heavily fund a life insurance contract through a split dollar loan regime from the nonprofit to the key executive or executives. At the appropriate time, hopefully we will have enough cash surrender value in the policy to repay the loan, and at that point, it's once again a personally owned portable policy that our executive now in retirement can use the additional surrender values for supplemental retirement income. There are other opportunities where sometimes we don't repay the nonprofit, and instead we keep that loan in place until death, what we call split dollar till death. And what that does is it allows the cash values to not be invaded to repay the outstanding loan balance. Instead, the death benefit will do that. That means that additional monies are available inside the policy for larger supplemental retirement income opportunities for the retiring executives. And then the third method I've seen for nonprofits with split dollar is once in a while, they'll just forgive the debt forgiveness. So at retirement, instead of having to repay the $700,000 that was loaned to our executives during the working years, they will just forgive repayment. At that point, that debt forgiveness is taxable to our executive, but that's a far less amount than the entire cash value being taxable to our executive. And frankly, the cash value can be used to pay the 32% tax on the debt forgiveness. So those are Randy, those are the 3 options that I have primarily seen for split dollar with not-for-profit organizations.
Yeah, I think that's kind of a nice overview. Dave, the other thing you didn't say, and it doesn't come up a whole heck of a lot, but sometimes I have gotten involved in the last few years. The 2017 Tax Act also created an excise tax on not-for-profits for compensation over $1 million. So if you have an executive, of a not-for-profit that's earning over $1 million. And who might that be? Well, oftentimes the football and basketball coaches, by the way. But it might be the chief executive officer or the head of the hospital. So there are examples of executives in not-for-profits who are earning over $1 million a year. So there's an excise tax on those dollars that exceed that limit. And I see a lot of times loan regime split dollar being used as a way to supplement that pay. That split dollar is not counted against that $1 million limit for that excise tax. So while those cases are relatively few and far in between, they can be very substantial ones, and it is a very good way to compensate those executives in a manner that helps avoid or at least minimize the payment of cost of that excise tax. And Bill actually earlier in the day just kind of teased how split dollar works, actually showed an example of that. A lot of you have heard about it. It's the Jim Harbaugh situation, Michigan football coach Jim Harbaugh. And that's something that Michigan did when they enticed Harbaugh to join 5 or 6 years ago, whenever it was, first started to coach up there. And that's maybe the most famous split dollar case that's out there. And Bill included that in his slideshow earlier. But we see that in the tax exempt world as well as a way to avoid that excise. Well, is there anything else, Dave, that you would like to add here for split dollar? I can have Kyle open it up, from a question standpoint.
Yeah, well, we do have some good questions on there, and Donald's collecting those right now. He's going to feed those to you guys. Before we end, the great part about this training and educational opportunity, it's not going to be the last one. We're going to continue to provide these opportunities. Next week, we're going to be breaking down the IUL multiplier marketplace with the 101 and 201 course. You can see those are same time on Wednesday of next week. So be looking for the registration email that should go out tomorrow, so you can take part in that too. Don, I'm going to pass it over to you. Do you see any good questions for Randy and Dave with kind of the remaining time that we have?
I see one here from Ben to the panelists. Are you allowed to use premium financing with this strategy? Let me try to answer that. Premium financing is a great tool, and it accomplishes a lot of the same leverage things that we talked about. But there is a strategy that I refer to as dual loan, which is pretty darn neat. If I have a client who needs or can benefit from a premium financing structure because they're earning an excess amount on their investments compared to what the bank interest loan is, what I can do through loan regime split dollar and premium financing by marrying them up is that client could go out and use non-life insurance policy assets to secure a bank loan. Maybe they use a piece of real estate. Maybe they use the family farm. Maybe they use whatever assets that they have, but they secure a loan with a third-party lender. They can then turn around and do a split dollar loan to a trust with the low interest rates, and they can lock in that 1.15 long-term 30-year AFR. Because a premium financing loan is going to be at 3 to 4% right now, and that's what the trust has to pay every year in interest. So if you're in a very large case situation where you're gift tax strapped, you're trying to minimize gift tax consequences by using that dual loan, by going and securing the outside third-party funds, and then turning around and using loan regime split dollar to fund that trust-owned policy, you can kind of double leverage, if you will. You're leveraging at the bank level, and then you're also leveraging at the trust level and being able to take advantage long-term of those low interest rates, which maximizes your estate and gift tax exemptions. I hope that makes sense. I know that's complicated, but that's kind of the answer to your question, Ben. Anything else there, Kyle or Donald, that you see that you think Dave and I should take a shot at before we sign off? Well, I'm going to take the silence to mean either that I've gotten lost or that everybody's good.
Well, we do have a couple questions if we want to gather those, but I did want to mention to everyone, if we don't get to those, we are collecting those. Obviously, we're right up against the time, so if we don't get to your question, we'll do every effort to answer that individually and email you. Dave, did you see one?
No, I haven't seen any of them.
Okay. Oh, I thought you were saying you saw a question.
No.
Go ahead. So we'll collect those questions. So I do want to take the time again to thank everyone for joining us today. If you're able to join us in the morning, thank you too for taking time to get to both training sessions. It was greatly appreciated. We will give you the follow-up information in terms of questions if we didn't get to them, as well as a copy of the recording and any of the presentation materials that you think that you'd like to have access to. So we'll get that information out to you. And as always, you know, during times like this, we appreciate your resilience working with Global Atlantic. Bill said it on the prior call. Let us know what we can do to help you out. Everyone's experience is different, and if there's anything that we can do to help you out from a Global Atlantic perspective, let us know. We'll see what we can do. So with that, I want to thank Dave and Randy. Great presentation, and I want to thank our attendees for taking time today. Have a great day.
Thank you, everybody.